Yeah? Oh, yes. Hey there, everyone. Today on the final bar, big tech pushes higher with Microsoft threatening a new all-time high. It's another heavy earnings week. We'll talk home builders, healthcare, and energy. Finally, Mike Singleton of Invictus Research will be joining us. What sort of big macro themes is he watching as we go through the end of 2023? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the price action of the markets using the best practices of technical analysis. Markets are never easy. Investing as a livelihood or as a hobby or as an area of focus has never been particularly easy. Sometimes a little more straightforward than others. I would argue this is one of those not so straightforward times. I feel like there are a lot of competing narratives. I feel like if you want to feel bulled up, if you want to feel bullish, I could probably come up with some macro factors that could certainly suggest further upside, probably primarily of which is the price, right? You have stocks like Microsoft and other leading growth stocks continuing to push to the upside. Also, plenty of competing narratives to the downside, right? Bearish thoughts about geopolitical events and the escalation in the Middle East, about interest rates remaining elevated, so forth and so on. At the end of the day, price is what matters. I would often say with some of my former colleagues at Fidelity, right? You don't get paid on relative strength. You don't get paid on earnings. You get paid on price. Focus on price, number one, and that's what's most important. When you look at the price of assets today, kind of choppy going into the close, but overall finishing stronger, continuing to push this upside strength that we observed through pretty much all of last week. Let's look at the evidence together on a market recap here and see how things actually played out. Before we do that, I do want to start with a poll question. We asked you recently, how would you describe your technical analysis expertise? This is more of a get a sense of where we're all at in terms of our command of the technical toolkit. Very few pure beginners, and I hope the fact that you found this show, the fact that you're looking for commentary and insights based on charting and technical analysis and macro strategy, I would assume you have at least some understanding of it. Most of us, I would say, about half of us in the intermediate category, having some experience with technical analysis, but still a lot to learn. Only 26% of you saying advanced. You know a lot about charts, just trying to refine those little things. And then 5% of you make the bold claim that you could sit in this seat and host the show. I welcome the opportunity for someone else to give it a shot. It's fun and challenging, all bundled into one. So why do we ask that question? So I think number one, it's important for you to understand where you're at in your journey. I always describe to people that I work with, particularly my premium members at Market Misbehavior, you're on an investing journey. And what I love about investing is whether you're early on, whether you're sort of in getting, going through your career sort of in the investing stage and really building up assets, or whether you're at the retirement age or beyond, you're always learning. And I've observed people in their teens and 20s asking thoughtful questions about the markets, and people in their 70s, 80s plus also asking some thoughtful and knowledgeable questions about the markets. Never stop learning, never stop trying to evolve and adapt to the markets. But whether you're a beginner, I would go to the chart school. I would start with a free resource on StockCharts.com and be a sponge. Watch this show and learn as much as you can. Anytime you see someone talking about something, buy a book about it and look it up. If you're in the intermediate stage, you have some experience, but you still have a lot to learn, that's where I would focus on what our guests are saying, right? Think about the comments that someone like Mike Singleton is saying. Think about the charts that he is sharing with you and how we can visualize markets over time. That's how you're going to improve your toolkit. If you're advanced, if you consider yourself a legend, I would say it's all about understanding how the markets are evolving, because you're only an expert as of this particular moment. Things are going to be different in 5 months, in 5 years, in 5 decades. So as the markets evolve, continue to evolve your toolkit. Be thoughtful, be respectful about how the markets are changing and what you might need to change or do to adapt to the market environment. Thanks so much for answering that poll question. Make sure you subscribe to our YouTube channel. You won't miss the next one. Let's continue on with our market recap. So as I mentioned, sort of a choppy end to the session. You can see I was joking with my guest today, Mike Singleton. The moment we brought him on and started talking before the show, the S&P just started rolling over immediately. So we can all blame Mike for that. I say that with a great deal of sarcasm. Sort of a choppy end to the session, but overall still finishing in the green pretty much across the board. The S&P up about 0.3%. We're getting back up to that 4,400 level. That would be the last swing high. I think that's an important one to watch to see if the S&P is indeed able to get above there. The Dow up about 0.2%. The NASDAQ up 0.9%. So leading the way higher. It was up a little bit further earlier in the day. Kind of came down just a bit, but still positive. Small caps actually down 0.7%. So if you're looking for that bullish validation of small caps finally participating in this uptrend, day like today, not necessarily giving you that satisfaction. The VIX, one of the things on the red, in the red on this first page, down below 15. That happened yesterday, so today not too much change from yesterday. But again, we're well below any sort of benchmark, any sort of level where you would assume is the sort of threshold between low volatility and high volatility. We are well below whatever level you might throw out. I often talk about 20. One of my guests last week mentioned 28.5 as sort of that key level, as long as we remain below that. But in any case, we are well below the realm of high volatility, certainly back into a low volatility bullish phase in the short term. Interest rates, for the most part, moving lower today. So you saw bonds rally. The TLT was up about 1.5%. The 10-year yield down to around 4.57, so that's around 4.6%. The long bond yield just about 4.7%. Of course, the short end of the curve still higher, so we still have that inverted yield curve we've been referencing quite some time. The dollar up about 1/3% from yesterday's close. Looking at commodities, a lot of red today. One of the things that jumped out at me as I was doing my morning coffee routine, that's where I look at a series of charts and just reflect on what's happening out of the open. A lot of downside gaps in the commodity ETFs like the DBC, which ended the day down 2.1%. Gold and silver both down as well. And we talked about gold really, resuming an uptrend, really testing, significant highs, but has really pulled back from that level. The GLD down below 183. Silver prices down a great deal, about 1.6%. Energy prices down a good amount. The USO, the crude oil ETF, down over 4%. Energy stocks not having a particularly strong day either. Looking at cryptocurrencies, Bitcoin really during the equity trading session spiking to the upside, pushing above 35,000. Now, after we got above that resistance around 30 to 31,000, the question was, I would say, what's that next level? And as we'll see in the chart of Bitcoin here in a bit, 35K has been sort of that new plateau, I would argue, sort of that new level of resistance. Today, pushing above there, up 1.6%. This is not a broad cryptocurrency move. This is a little more on Bitcoin, although a lot of them sort of rallied together here in the last 6 hours or so. Overall, Bitcoin leading the way higher, up about 1.6% from yesterday. Looking at the sector returns today, technology and consumer discretionary essentially tied for first place, both up 1.1%. Communication services number 3, up 0.5%. So you have your FANG sectors 1, 2, 3 at the top of the list. We're back to that growth-oriented up day that we've seems familiar through a lot of the last year. Looking at the downside, energy down 2.2%, materials down 1.9%. Then some of the defensive sectors like REITs and utilities both down about 0.7 to 0.9%. So energy really the biggest, the biggest laggard today, underperforming the S&P by a decent amount. Let's go to a daily chart of the S&P 500, just sort of see where things are at. Now, we've talked about some of these resistance levels, some of these trend lines coming off the previous highs. There's a pretty good trend channel with the QQQ, and I'll make a note to go there next because that's kind of an interesting one, fairly actionable with today's bounce higher. But if you look, the S&P, of course, 2 weeks ago was all about distribution. Last week, all about accumulation. I think this week, very much a question mark to see if we get that upside follow through. For now, certainly appears to be doing so. Now, the pace of last week's advance has slowed down. You're sort of seeing a slower incline, but we're seeing higher highs today from the last couple days, and the S&P 500 getting near that trend line. The reason why I talked about 4,400, that's the previous swing high in October, and that's also a trend line off of the July, August, September highs. So the reason why that's an important level, I would argue, is for a couple of reasons. Number one, and probably the most important, is because once we get above 4,400, that would make a higher high, right? So one of the definitions of a downtrend is a pattern of lower highs and lower lows. So what I would argue, you're looking for that pattern to change. So in September, into October, into late October, we've seen lower lows in price that really has continued since late July. We've seen lower highs as well. The way that this reverses, according to Charles Dow, 130 years ago or so, was a pattern has to change. You make higher highs and higher lows. So we're kind of right at that point. S&P above 4,400, all of a sudden the trend, as illustrated by this chart, maybe a little bit different. Also breaking above trendline resistance, pretty important. Now, if we go to a chart of the QQQ, this is a chart we highlighted, I think, yesterday on the show, and we've done it elsewhere. On the Qs, on semiconductors, what's interesting is it's this sort of real, clearly defined downtrend channel. And that's when you have a pattern of lower highs and lower lows, and the extremes are parallel, right? So I drew a trend line off of the highs here. You can see that these early highs line up very well with subsequent highs in August, September, October. I drew a parallel line down here, and look at how well that matches the lows. So what you're looking for is the price to break out of that channel. Arguably, we've seen that today. We've now closed outside the channel for the first time in the last 3 months. The RSI has gone up to the bullish range, getting above 60. Now it's about follow through. Now it's about Wednesday's session to see if we follow through on today's breakout. But overall, kind of a nice development, bullish development to be clear with the QQQ. I mentioned Bitcoin, and just to quickly look at that chart to show you what I was talking about with that level around 35,000. So what we've been talking about before was sort of this area here, 30 to 31,000. That was the resistance in April of this year, and that was actually coming off of the November low. You had this big move higher to a peak here. We stalled out just above 30,000. We pulled back. We then retested it, had this great bearish momentum divergence in June and July. We pulled back and retested support. Now all of a sudden we're breaking out to the upside. What's interesting about that is after this big move higher here in mid-October, now we've continued this trajectory. And look at how the highs and the lows have all gotten higher. We're sort of continuing to push to the upside. So once again, threatening 36,000. I would argue a chart like this is bullish until proven otherwise. I always like to think of charts as guilty until proven innocent, or in this case, innocent until proven guilty. Look for signs that the uptrend is no longer in place. For now, making higher highs consistently is a pretty good argument. Now, we have to point out when we're looking at the dashboard, one of the chart lists that is so important to me that I have it right on my front page here is what I call the Magnificent Seven and Friends. This includes 8 mega cap growth stocks that I think are, again, just represent such a significant weight in the S&P 500 and then the NASDAQ 100. And just recognizing the fact that these are the numbers that you're seeing on charts like Amazon, on Apple, and Tesla. And when those are the numbers you're seeing from some of those leading names in consumer discretionary and technology, pretty safe bet that the markets as a whole are pushing to the upside as well, because these represent a huge weight in the S&P, a huge weight in the NASDAQ 100, and certainly some of the major sector spiders like the XLK and the XLY. Over half of those ETFs are basically represented with the tickers that you see here in this chart list. So I think the mega cap growth trade working today is kind of what's helping this week, continuing to push the benchmarks to the upside. To wrap up our market recap, let's look at some of the individual names. Got a lot of earnings right now, but I just want to highlight some of the stocks that are catching my eye. One of the things that I wanted to note is just one of the biggest gainers today in the list I was looking at is Gen Digital, GEN. It's maybe a name you're not as familiar with. It's a large cap, but slightly. It's at a 12 billion market cap in the software space. I just wanted to highlight just a classic example of a bullish momentum divergence. We had our live Q&A on yesterday's show on Monday, and we had a question about divergences, and it sort of had it in my head to look for some examples. I just want to share, this is one that popped up as I was looking through the charts today. And what makes it a classic bullish divergence? So it starts with price. Price has to be making lower lows. You then go down to the momentum, and the momentum has to be making higher lows. And ideally, the first low is oversold, according to the momentum indicator. The second low, which is a lower low in price, actually does not make a lower low in momentum. So lower prices on less negative momentum is that bullish divergence that we talked about. That usually is a leading indicator that the downtrend is starting to be exhausted and you're looking for a bounce to the upside. Today's gap higher, taking GEN up about 8.5% back above the 200-day moving average, comes after that bullish momentum divergence. So I want to share that example with you guys. Another one, we've talked about this on the show here. This is an earnings name from last week, DraftKings, continuing to follow through to the upside. And one of the things that we've talked about recently are price gaps, particularly when you get a gap, which a lot of ways, it's tough to predict when a stock is going to gap up or down. A lot of times it can be earnings, and you can assume, all right, we might get a big revaluation of this stock from one day to the next. But a lot of times it just happens because of some news flow, maybe earnings something else. So while you can't always predict what happens, to create a gap, because that a lot of times will be some news outside of the trading session, you can look at what happens after the gap. And when conditions are less optimal, when conditions are bearish, any sort of good news, you'll see a gap higher. You'll often see the stock trade lower after the gap and then follow through to the downside because there's a gap higher. But since it's a bearish environment, there aren't a lot of new buyers coming in willing to pay more and more for a stock. Even on good news, they're just happy for the pop in price to unwind positions and take some profits and at least log some sort of gains in a difficult tape. So the gap higher and then drift lower is usually more of a bearish sign of the market conditions. Here you see the opposite. Names like DraftKings gapping higher, closing higher, but then the rest of this week so far continuing to push higher and higher to the upside. So I think that's an encouraging sign for DraftKings. Also an encouraging sign for the market environment that buyers are willing to come in and push a price like DKNG to a new 52-week high after that gap higher. It is in that overbought region, so always be wary. Could be a short-term pullback, but overall I think a lot to like still on a chart like DraftKings. In terms of earnings names today, you had a couple before the market. DR Horton, DHI is one to look at. And when you look at this particular chart, I would note the fact that it's up 3%. And what's interesting about home builders were one of the better places to be. It's certainly one of the better relative charts in the first half of 2023. I mean, look at DHI, you can look at Lennar and other home builders as well. Really from third, fourth quarter of last year, consistent outperformance really through the summer, right? So you had this strong group, strong trend, strong relative performance. That changed, of course, and as the markets have pulled back, home builders have actually pulled back even more, so they've been underperforming. That's changing now from mid-October now to early November. You're seeing stocks like DR Horton with a bullish momentum divergence, notably as it hits $100 a share, pushing back to the upside, gapping higher, following through earnings today. You also have Uber, which is another name, obviously reporting earnings today, gapping higher, not gapping actually, it's trading higher today, just under 4%. What's interesting about the chart of Uber is you've rallied up on earnings to a significant resistance level. And for me, when I'm looking at a chart like this, it's still a question mark in my head because we've now traded up to that level. I would often say it's not enough to trade to resistance. You need to trade through resistance. And for me, that means you have to close above that resistance level here around 48.50, or 49, and then we need to see follow through. So I would say for a chart like Uber, it's not just about today, it's about what happens tomorrow, the next day, to see if you see additional buyers coming in willing to push Uber to further highs beyond what we've seen so far this week. Just quickly talking about earnings after the close here, we have a biotech name, Gilead, to tell you about. This is a stock that gapped higher a couple days ago. I think this was on Friday, Thursday of last week. Then we've seen a bit of a rotation lower. It was down slightly today, so it'll be interesting to see what happens after the close. This is when we actually have a bearish momentum divergence. So higher highs mid-October to early November, weaker momentum. So it's actually kind of a negative technical setup going into earnings. If you do have a good quarter and you do have some upside follow through, highs here around 84.50, 85, looming large above current levels. So I think it's still a lot to be proven there. Another, just a group to finish up here, would be some of the energy names. Oil prices coming off today. The energy sector, the worst performer, down over 2% for the XLE. You have charts like Devon Energy down 3%. Chart like Occidental down about 2.5%. So both of these, Occidental, for example, coming down off of an unsuccessful test of resistance. Tested the September high, failed to really get above there in mid-October, now back to the low. So maybe looking at some support levels to see if they're able to hold in the situation that these names surprise to the downside. That's our market recap. Again, a lot of fluidity, a lot of movements, but at the end of the day, a lot of macro themes to think about. I'm excited to talk to Mike Singleton of Invictus Research here in a moment. Really thoughtful macro strategist. We'll see what sort of perspective he can shine, what lights he can shine on the markets right here. Before we bring on Mike, I just want to let you know, as a reminder, we are always excited to hear from you, but particularly looking for your questions. Our mailbag can always use another question from you. You have a couple ways you can get your questions in front of us. Email always works. TheFinalBar@StockCharts.com. On Twitter, just tag us in a comment at Final Bar SCTV on our YouTube channel. Of course, you can drop a comment below the video that you're watching. Also, during a live broadcast like this one, just put a comment in our live Q&A. We'll gather all of those questions and hope to answer one of yours in a future mailbag segment. I want to welcome on today's guest, Mike Singleton. Mike's a senior analyst at Invictus Research, coming to us, I think, from Annapolis, Maryland. Is that right, Mike?
That's right.
Good to see you again. You were on the show earlier this year. I had a really good conversation. I'm excited to bring you back on here. As I bring up your charts, we're coming off of Fed Week. We're coming off of a lot of, I think, question marks about interest rates and what those how those conditions have evolved. We're starting with your chart of the 10-year yield. Talk us through what you heard over the last week and where you see things headed going forward.
So obviously the 10-year yield has come down quite a bit since we got the quarterly refunding announcement from the Treasury the other week and the Fed meeting and some economic data like the ISM manufacturing report. So when we think about the 10-year yield right now at Invictus, we actually have kind of a divergent fundamental view and technical view. So on the fundamental side, we think that all of the drivers of higher rates are still intact, and we have some of them listed on the slide shown, right? Do we still have a relatively tight labor market? Yes, the unemployment rate is still sub 4%. Wage growth is still, 4.5% or so, depending on where you look. Is the Treasury still issuing, a lot of debt because we're spending a lot of money? Congress has legislated the spending of a lot of money. Yes. Is the Fed still doing quantitative tightening? Yes. All of those things are going to be putting upward pressure on rates over time, assuming no recession. So that said, we are below 5.25%, which is what we think is the next significant level of resistance for the 10-year yield. So tactically, at Invictus, we don't think it really makes sense to be shorting bonds right here, so to speak. And we didn't, it's easy to say that now after they've, caught a bid for the last few days. But even heading into that resistance level, we were pretty clear, look, this is an important level of support for bonds, resistance for rates, whatever you want to call it. This is not a time to be YOLOing your Treasury shorts.
I love your way of describing that. Your second chart really speaks to, I think, why we want to follow the 10-year yield. Can you talk us through this visualization? I think it's a great way of showing why the 10-year is so important.
Right. So there are a number of reasons. There's sort of technical intermarket reasons, and there's also fundamental reasons. On the left, you're getting more of a technical intermarket reason. You can see the inverse. You can see the correlation between the dividend yield for the S&P 500 and the 10-year yield is quite close, especially over the last few years. It's about 71%. So, obviously the implication of that is when rates go up, it puts valuation pressure on stocks. And depending on the valuation of those stocks or the growth rates of those stocks, that pressure can be more or less intense. Obviously, growth stocks historically have tended to be more sensitive to rates. That may not be the case right now. Obviously, growth stocks have done very, very well. But that historical relationship is still worth being aware of. On the right, you have the relationship between the 10-year yield and the 30-year fixed mortgage rate. That's more of a fundamental transmission mechanism of monetary policy. You can see, obviously, the correlation between the 10-year and the 30-year mortgage is very close. And the reason that matters is because the housing market and mortgage rates are a very important transmission mechanism of monetary policy. So when the Fed allows the 10-year to go up, or the Treasury through its issuance choices, that makes mortgage rates more expensive for consumers. It creates a massive headwind for demand for new homes because financing a new home purchase with a mortgage becomes much more challenging. And that's why you've seen mortgage applications decline in the US by about 65% from their cycle high in early 2021. So we can get more into the business cycle weeds if you'd like, but that's a really important fundamental economic relationship.
Yeah, it's so funny. We talk so much about the 10-year and where it is. That was a really good illustration, Mike, of why it's so important. And I know, having just bought a car last week, higher rates matter, right? It actually has a direct impact when you go to make one of those larger purchases. Can you put on your technical analysis hat, which I know you have? Talk to us about this particular ratio, because I think it's a good illustration of sort of a risk assessment, risk appetite, I would say, right?
Sure. So we're looking at, so let me take a step back. Something that pretty much every investor looks at is credit spreads. And credit spreads are important because credit investors are smarter than equity investors, as the saying goes, but also because credit spreads track the growth cycle. So when economic growth is declining, you would expect credit spreads to widen. Now, since early 2021, when we saw the peak in new highs for a lot of different indexes, and we saw a lot of different stock exposures roll over, like IPOs and unprofitable tech, like the ARK funds, and you could go on and on. That was because growth was rolling over. Anyway, economic growth has been slowing since early 2021, and yet credit spreads have remained quite resilient. Everyone talks about spreads. So on this slide, we're looking at spreads a little bit of a different way. We're looking at the ratio of the high yield ETF, HYG, over the like duration treasury ETF, IEI. Basically, it spreads upside down. So the question that we're posing on this chart is this a chart that you would want to buy? If this were the chart of a stock, would you be looking to buy here or sell here? And in our view, this looks more like a sell, right? It looks like it's rolling over around resistance. If you look at the momentum profile on the bottom of the page, momentum is making lower highs. It's actually getting oversold. It's not getting overbought. That's more consistent with downtrends and uptrends if you look at market history for pretty much any tradable risk exposure. And so what that tells us is that at this point in the cycle, even though spreads remain impressively low relative to growth conditions, they're vulnerable to widening at this point.
Beautifully said. And I love the use of RSI really shows. I totally see what you're saying in terms of that ratio starting to roll over to the downside. Talk about key levels for the S&P 500. Obviously, we're sort of bouncing. The last 2 weeks have been sort of feast or famine. It's either the worst week ever or the best week ever. Where do you see things now looking between now and year end?
So it's a good question, and I'll start with what we're showing you in this chart. We have support drawn at 4,200 roughly. I know the first half of 2023, all anyone could talk about was 4,200. And now that we're above 4,200, I think everyone was caught by surprise that the market rallied off of that level. But that's how markets work. That's why technical analysis is an important discipline, right? Because we saw resistance become support. And on top of that, we don't have RSI momentum drawn on that slide, but the S&P 500 got oversold into support. And that's not a setup that we like to short generally at Invictus. If you look at the average 3-month returns going forward, when momentum in the S&P 500 gets oversold, it's about 5% or so. And if you were to look at a T statistic for that 5.2% return relative to the average returns for the S&P 500 over any given period, it's over 2, which means it's statistically significant, which means, long story short, you generally don't want to be adding to your short positions into support as momentum is getting oversold, at least if your time horizon is 3 months, which if you're selling short, you're probably not going to be that, you can't be that long term unless you want to get your, face ripped off.
Right.
So that's something that we were talking with our clients about ahead of time.
I've talked to very few investors that are looking forward to getting their face ripped off. So I think that's a good way of describing it. Seasonality, of course, right? The last couple of months of the year usually tend to be pretty strong. How does the strong seasonality tend to, I guess, or how does that relate to what we talked about this the short-term rally we've seen so far?
So we don't necessarily place a ton of weight on seasonality at Invictus. That said, November and December are the strongest 2 consecutive months of the year, which you can see on that chart. If you were to look at the T statistics, they're roughly 1, which means that they're not statistically significant. The only really important T test is for September. You can see that's well over 2.
Right.
But that said, do you want to be maxed out on your shorts heading into the seasonally strongest part of the year? I mean, I guess the answer is maybe, but you have to have a very good reason. You have to have a high level of conviction, and you have to know how to manage your risk if you're going to do that. So it's not to say that we're bullish, because we're certainly not fundamentally bullish right now at Invictus, but you do want to be aware of risks to your thesis. And, I'm constantly surprised at how often seasonality tends to play out as you would expect, even though it almost seems like so simple. How could it be true?
I love that quote. You need to be aware of risks to your thesis. If only we would all do well with that, Mike. That's well said. Can we just to continue on here? Talk to us about some of these groups here. We've seen some of these areas of the market, retail. We're starting with really getting beaten down, particularly on a relative basis. What does this tell you about the trajectory of these sectors going into early mid-November here?
So the seasonality perspective is a reason to be bullish or less bearish, if you will. That said, it's one of the few reasons that we can find to be bullish or less bearish at Invictus, because generally we think economically things don't look great. Stan Druckenmiller famously said that the best economist he knows is the inside of the stock market. And what he meant by that is the market internals, right? The relative performance dynamics taking place under the hood. And so on this slide and on a few subsequent slides, we've laid out some important cyclical leading risk exposures. So in this slide, we've got the performance of the equal weight retail stock ETF, ticker XRT. We're also looking at the relative performance lines on this slide is the small cap to large cap ratio. All of these exposures that Dave is going through, transports, they are pro-cyclical exposures. They're exposures that are positively correlated with the growth cycle. So if we were in a new bull market or a new economic expansion, what you would expect to see is retail leading the market, small caps leading the market, transports leading the market, leisure and entertainment stocks leading the market. And that's not the case. These market internals are really, really messy. And we could point to a few counterexamples. I think the next slide is the ratio of high beta to low beta stocks. That looks better. The ratio of discretionary to staple stocks on either a large cap basis or an equal weight basis, they do look better. I'd say the weight of the evidence when I look across the intermarket complex at Invictus is messy to slightly bearish. And the market is clearly flashing what I would say are yellow lights turning red. They're telling you that you need to be paying attention to risk right now. If you, if you are bullish, maybe run with tighter stops than you usually do. If you're buying breakouts, either buy fewer of them or run with tighter stops. And if you you're running a portfolio, maybe run with net exposure on the lower end of whatever your tolerance is.
It's such an interesting time, Mike, and I agree with you. Maybe a time to be wary, a time to be cautious, and let's see how things play out here. This has been a lot of fun. I wish we could do this for an hour, Mike. It's such a pleasure to bring you on. Great insights, great expertise, and thanks for bringing some charts with you. Be well, stay safe there in Maryland. We'll talk to you again soon.
Thanks for having me back.
That's Mike Singleton. Mike is a senior analyst at Invictus Research, coming to us from Annapolis, Maryland. Every one of those charts, to be honest with you, and some of Mike's comments, I would encourage you to go back and review those. Just a lot of thoughtful perspective on what we're seeing, we're hearing. Right at the beginning, we talked about interest rates. It's so funny. We talked so much about what the 10-year is doing, what rates are doing, what bonds are doing. I thought that was just a great, quick summary about why it's important, how it tends to impact valuations, how it tends to impact consumer spending and borrowing. Great insights and great perspective there from Mike Singleton at Invictus Research. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes to tell the story of this market environment. Here is chart number 1. If I can get to it, let's try it here. 1 moment. We got there. Okay, chart number 1. I thought Mike Singleton's comments were fantastic. I really love his perspective on, thinking about some of those key groups that have been underperforming. And it's funny, one of the charts that I set up earlier today that I wanted to share with you, I was looking at year-to-date returns as part of my normal exercise. One of the things I noticed, the QQQ year-to-date returns up 40+%, just under 41%. Down tier, the S&P 500 up 15.6%. The Dow up 4.8%. The equal-weighted S&P just slightly positive, up almost 1%. Small caps with today actually slightly negative. The Russell 2000 ETF is actually down about 0.25%. When you think about the dominance of the mega cap growth trade, when you think about the relationship between large caps and small caps, and why so many of my guests continue to press this issue that there's this huge performance gap, look at the gap on this chart from the Microsoft, Apple, Nvidia, Tesla types of names down to sort of everything else. There is a big gap, and the smaller and the further away you get from mega cap growth stocks, the worse and worse of a 2023 that it was. If you bought an equal weighted S&P and a Russell 2000 at the beginning of this year, you were literally flat. While stocks like Microsoft are making another new all-time high and the Qs are up over 40%. That was a striking illustration of what we've experienced so far in 2023. Chart number 2 is Microsoft, and we're looking at the weekly chart here just to illustrate the fact that this breakout in Microsoft certainly seems significant by my read. Now, again, I think there's a lot of reasons to be skeptical of further upside. I think in a rising rate and in an elevated interest rate environment, what's the opportunity for growth stocks to be continued to be valued higher and higher given higher rates, which literally by definition are sort of lowering the valuation traditionally of these growth stocks. At the end of the day, the chart is doing what the chart is doing, and you can see Microsoft making a new high. You can see the significance of what I would describe as a big, huge cup and handle pattern appearing to break out. So let's see what happens through the remainder of this week and beyond. But how bearish do you want to be when Microsoft is making new highs? Finally, the chart of Disney. Disney's reporting after the close today. We'll have to see what happens with their earnings release and what happens with the call afterwards. And certainly I would keep your eyes on Disney on Wednesday. I just want to highlight quickly that Disney has literally been range bound. This is one of the charts we've been asked about a lot recently. And if you look on the upper end, just above $86 a share, on the lower end, around $79, $80 a share, this is going to break one way or the other. Now, earnings are often a catalyst that can propel a stock like Disney out of that range. We'll see if that actually plays out. But I would be setting an alert just above 86 to see if Disney can get that upside follow through and maybe start to reverse this long-term downtrend. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Mike Singleton of Invictus Research joining us from Maryland. Don't forget to like this video and subscribe to our channel while you're here. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.